What's up, everybody? Welcome back to another Wednesday night live stream real estate recap where we talk about everything to do with the housing market and some other stuff. Got another great live for you tonight, bringing back one of my favorite guests. She's been on before. Wealth of knowledge, wealth of experience with mortgage lending, Franckie DiFrancesco. I'm going to bring her on in a second. Got some articles to share with you guys. We're going to talk about everything to do with mortgage rates and also different possibilities to get in this housing market if you want, without having to put 20% down on a conventional loan. There are other ways. So we're going to touch on all those. I also have some warnings to go over, different stuff to do with lending and fraud and all kinds of stuff. If you're watching this live and you have any questions for me or Franckie, put them in the chat. And if you're watching this on the replay and you have any questions for me or for her, put them in the comments. We will get them answered and get back to you. So let me bring Franckie on. Hey there.
Hi, how are you? How are you doing, Caryn? Nice to see you again, and thank you for having me back.
Thanks for coming back. You know, you have so much experience, so much knowledge. There's a lot of conversation going on with what's happening in the market and with interest rates and everything else. So I'm really, really happy you're here. Thank you for being here. And let me bring up the first article because it'll start us off on the conversation that I want to have. Hang on.
Great.
Let me bring it up. Okay. You see that all right? All right, let me just read this. So it's written today, January 15th. Mortgage rates have hardly moved since yesterday. For example, according to Zillow, the 30-year fixed mortgage rate is down by just 1 basis point to 6.87%. Meanwhile, the 15-year fixed interest rate has increased by only 1 basis point to 6.17%. This morning, the U.S. Bureau of Labor Statistics released the latest Consumer Price Index, or CPI, which is a key measure of inflation. December's month-over-month core inflation rose by 0.2%, a slowdown from November's 0.3% increase. Annual core inflation also went up by 3.2%. This is still above the Fed's target of 2%, but it's the first annual decrease since July. The numbers are better than the economists expected, but still high enough for them to be confident the Federal Reserve won't cut its rate at the January meeting. So mortgage rates could stay fairly stagnant for a bit longer. And then it goes down to quote today's mortgage rates based on, I guess, national data. I'm going to go through them, just the first couple, and then I'm going to talk to you about it. So they're saying the 30-year fixed is 6.87%, 20-year fixed 6.77%, 15-year fixed 6.17%, and then they go to the ARMs, 5-year ARM 6.72%. So interesting. And the 7-year ARM 6.69%. And I'm bringing them up for a reason because I want to see what you think of what they're saying.
Well, great. Well, thank you for that. First of all, that was really helpful. And you're correct that inflation is really what we look at when we want to pay attention to where mortgage rates are headed. Because if we really kind of do look back and we see when the Fed made 2 rate cuts in 2024, actually mortgage rates went up. And it was because of other factors that really dive into mortgage rates. And that is always going to be first and foremost, no matter what time of year it is, when it is inflation that is the number one indicator of where mortgage rates are headed. And yes, we got some good news today, but it kind of fell off of the historic pattern of day after day almost over the last few weeks of numbers not doing great and a lot of uncertainty in the market, a lot of different numbers. The unemployment figures came in. That's the second number I would say that you want to pay attention to if you're really trying to track mortgage rates. So number 1, inflation, and number 2, unemployment rates. These rates historically are phenomenal. It's just that they're tough when they're coupled with the price of the market conditions and where homes are right now. We have a lot of ways to walk and talk around that. But I would say that based off of what you're sharing on the screen right now, these rates seem pretty accurate. This does not include high balance loans, and it doesn't include jumbo loans on this worksheet. But a lot of times you will find that in this marketplace, sometimes the government programs such as FHA and VA offer better rates, but they still may be more costly to the consumer.
Yeah, and we'll get to those in a second. But before we get to the different loan programs. I do want to, since we are on this, I do want you to touch on, so people can understand the benefits, the pros and the cons to a 30-year fixed versus, let's say, a 15-year fixed versus an ARM. We don't have to get into the 20-year or the 5 versus 7, but just 30-year versus 15-year versus the ARM.
Right. Well, the shorter term of a loan always means the less interest you pay a bank over the long haul. So if you can afford a short-term loan, such as a 15-year loan over a 30-year, over the life of the loan, you, the consumer, are saving money. But it is going to come at a higher cost per month, because what it means is that loan is only stretched over 15 years, which is 180 months, where 30-year is stretched over 30 years at 360 months. So that is the big difference between the two. And with such a small delta between a 30 and a 15, I would arm more on the 30-year fixed right now. And then when rates do, in fact, drop in the future, if you feel very comfortable, maybe then taking the shorter term loan. I don't see a huge swing. It looks like it's about 0.7%. But when you really figure out that payment difference between 15 and 30, it's pretty costly to go with a 15-year loan unless you have really deep pockets on the income side.
So why would anyone pick 15-year over 30-year?
Perhaps they know that they can swing the payment, and for them, a 0.7 difference is enough to swing it, and they want to pay less over the life of the loan. Then by all means, the 15-year makes sense. You find most people who like 15-year mortgages are not first-time home buyers. They're usually move-up buyers who have a tremendous amount of equity to put down on the home, and they also may be closer to retirement age, so they don't want to go into retirement with a big mortgage.
Okay. And then why would somebody pick an ARM? I'm surprised that the ARM rates there isn't a bigger difference between them and the 30-year fixed. And my experience back in the day when before 2008, they were so popular, but there was a huge difference between a 5 and a 7-year ARM and a 30-year fixed. This is not showing a difference at all.
No, and it's really why the 30-year fixed rate has been completely outpacing adjustable rate mortgages probably over the last 4 years, maybe even 5. And that is because there is no swing really difference here. I don't ever see a benefit, maybe in the jumbo territory, but in the conforming territory, Fannie Mae and Freddie Mac have zero appetite for these shorter term loans. There's just not enough of a margin, is what they would call that, in those programs to make them more beneficial to the consumer. So again, as you saw here, we're talking such a minuscule difference. Unless you really knew that you were definitely selling that home in a couple years, you were buying it was a short-term loan, that would be maybe the only reason why, again, based off of these rates that you're showing up on the screen, one would lean on an adjustable over a fixed.
Okay. Yeah. Because like I said, they used to be really popular, and there's been a lot of talk like between, the internet and people talking like, well, now's the time to do, an ARM because you get a lower rate. When in fact, looking at these, it seems very risky, because after that 5 years or that 7 years, what happens? That payment goes way up.
Well, it can go up. It can do a lot of different things, but it is tied to wherever the 1-year treasury is at that time and the adjustments in the lifetime cap. Certainly not worth the risk. Not worth the risk. So again, most folks don't have the appetite for that type of risk unless it's a very large loan and literally a 0.25% difference to rate maybe changes the payment difference by a good like $300-400. Then maybe that's why in the jumbo space, they become more popular when the loan amounts are greater. But in this loan amount of, say, call it 800,000 and under, I would not say that adjustable rates have in any way made a comeback.
So if they're jumbo loans, if the loan is for over 800,000, does it make a big difference?
It could, depending about the difference in the delta of the rate. I would say when you see at least 3/8 to 0.5% difference, then a 7-year ARM, and I don't know if that chart showed it. I thought the 7-year showed price better than the 5, because again, those short-term trading instruments are just not doing anything to make the market want to sell that program and product. It's just, the banks don't have any appetite for the return on those. But I thought that the 5-year ARM, yeah, look at that. The 5-year ARM costs more than the 7-year. That's what I thought I saw.
Yeah.
So, and also you have to remember on those 5-year ARMs and 7-year ARMs, a lot of the times you don't qualify at the initial offered rate. The bank will qualify you at a higher rate of interest because they're going to take into consideration what happens if you stay in the loan past the 5 or 7 years and the rate turns into an adjustable. So know that even sometimes when you pick those lower rate adjustable rate mortgages, which again, we're saying doesn't have a big delta, you may not even qualify for them if your debt ratio was tight.
So, and I don't know if you can answer this question or not, but what happens on year 6 of this 5-year ARM?
It goes to wherever the 1-year trading adjustable rate mortgage is at that point, plus the margin on that loan. And every investor may have different margins. Usually it's a 2% increase in year 1. Wow. So let's just say at year 5, at the anniversary, you're starting year 6 out, and the 1-year treasury is trading at 3%. 3% plus 2% would mean that loan rate would only go down to 5%. But if the 1-year treasury bill at that time is 6%, 6% plus 2% would be 8%. And that's the unknown, because what we don't know is where the 1-year treasury will be at the end of 5 years or 7 years. We can't predict where that will trade on that anniversary date.
So what is it today? Do you know?
I don't, but I can find out for you.
Yeah, no, I'm just curious. Like,
my head.
Sorry, I don't mean to put you on this.
Sorry.
I get a little nerdy about the numbers. I'm like, oh, so if it's there, then what is, so I'm just curious, like where do they come up with these rates? The 6.87, I know how they're affected mostly by inflation and by the jobs report. But at the end of the day, like where do they come up with the numbers?
I think today it's trading at 4.22. So if the margin on that would be 2%, that rate would be at 6.22 right now. If you say we're at the 6th year of your anniversary of your ARM that you'd already had for 5 years.
Gotcha.
So it could be actually, if you look at this exercise, trading lower today. But again, you have to pay attention to the margins, the caps, and the lifetime caps of these loans, because in some years it can go as much as 5% above the initial start rate. And so while maybe in year 1, it's only 2% of adjustment, it can continue to build year over year, or it can go in a cycle where it goes up and down. You just have to really read the fine print of when you're taking an adjustable rate, not just where the rate will be for that period that it's fixed for, but what it can in fact do at the end of the adjustable phase, should you stay in that loan.
Okay. So just for our viewers, for anyone who's watching this live or on the replay, if you're thinking about buying a house and somebody comes to talk to you and they're like, here's how much money I make, here's my application, how do you advise them on which loan to pick? Is it based on purely the interest rate, or is it based on what they want to do in their life, how long they're going to stay in the house? Like, what are the questions you ask if somebody's watching this? Like, well, what would I do? A 30-year, a 15, a 5, a 1? Like, forget about, we'll go into the government loans in a little bit. Let's just stick with conventional right now.
Because that really lends itself to the difference between rate quotes and financial advising, right? So every customer's life is different. Nobody has the same story. And so as a loan originator, it is paramount, just like you talk to your financial advisor about your short-term goals and your long-term goals, you talk to us and you share the story of what you're trying to achieve. And then we can show you a series of different ideas. Then we will line up a secondary call, dive into those ideas, talk about the short-term gains, talk about the long-term gains, and then let people tailor the mortgage to their needs, not my needs, but their needs. But you've got to show them options, and you've got to make sure you empower them by educating them on all of the ideas that you have, and that can really help them out.
Yeah. Slimmy Jimmy says, buying a home is stressful enough, and ARM is no bueno for me. It makes sense, because that would add stress. Would for me, if I knew, like, oh my gosh, time's running out in 3 more years and 2 more years and 1 more year. I don't know what it's going to be. I mean, that's pretty stressful, you know?
Yeah, and the majority of first-time home buyers, because it's like anything, like riding a bike. You've got to get into it a little bit to kind of know what it feels like to be paying a mortgage as opposed to the rent that you were paying prior to. So the majority of first-time home buyers are fixed-rate borrowers. Some really want to dive in and see the difference in the delta and decide to pick an adjustable rate. But again, you've got to, if you don't educate folks on the cons of an adjustable rate, which don't mean that that is the wrong loan for them, it just means that you've got to let them know what happens at the end of 10 years or 7 years or 5 years. And what it is we don't know where the 1-year treasury is. What we do know is what the adjustments in the lifetime caps and the highest the rate could go, and you just have to then decide on if you want to take the risk for the savings. Right. But again, the majority of folks are for fixed, especially in today's environment, because I know you've been at this forever too, and I've been doing mortgages for 27 years. There used to be a time that it was very popular to buy ARMs, and then even some of my clients would go from ARM to ARM to ARM because of the delta. There's not a delta right now, Caryn. I don't see a benefit in an adjustable rate mortgage right now. There's no appetite, and there's really no reason to pick one.
Yeah, no, I concur. All right, let me bring up the article that I first was talking about. Okay. So will mortgage rates fall below 6% in 2025? Some mortgage professionals see the potential for a gradual decline in mortgage rates this year, while others warn that current rates might be here to stay. Chris Heller, president of Motivo.com, believes a drop below 6% is possible, though he emphasizes it won't happen overnight. On the other hand, Toma Mortgage's senior vice president and chief market analyst, Emmanuel Santadonato, suggests historical patterns make it unlikely for mortgage rates to fall below 6% at any point this year. Other forecasts land somewhere in the middle. While I'd love to say rates will drop below 6% in 2025, I think it's a moderate probability and not a certainty, says Stephen Parangi, a licensed mortgage loan originator and owner of Alpine Mortgage Services. His view aligns with the Mortgage Bankers Association's prediction that rates will stay between 6% and 7% throughout the year. Before you make any home buying decisions, let's look at what might drive rates down towards that 6% threshold and what could keep them at current levels or even push them higher. Okay, so what could make mortgage rates drop back to 6% this year? For rates to fall below 6%, inflation would need to show sustained moderation, prompting the Federal Reserve to ease monetary policy, says Heller. It may help to monitor the consumer price index, as several months of lower numbers can signal prices are finally cooling. A slowing economy could also push mortgage rates lower, but Parangi warns this isn't guaranteed. A mild recession would push rates down as the Fed tries to stimulate growth, Parangi says, but it isn't always good for mortgage rates if it brings market instability or more inflation. Even if conditions improve, experts say you shouldn't expect dramatic changes. The U.S. economy has proven resilient despite restrictive monetary policy, says Santadonato. Santadonato points out that incoming administration's potential tax cuts could boost growth, making big rate cuts less likely in 2025. I know you don't have a crystal ball, but what do you think? Do you think we're going to see rates come down to 6 or lower this year or in the near future?
Maybe in the future, but not this year is my hunch. Don't hold me to it.
Right.
I think that maybe we'll get 2 Fed rate cuts, which will certainly help home equities, student loans, credit cards, other debt, which I think is something important to do. But as far as mortgage rates, I don't think that we're going to see that big of a drop unless something drastic happens. With inflation, improving, that's always going to help the rates. But there is a lot of uncertainty out there right now. There is a tremendous amount of turmoil, I would say, where there is just so many different economic indicators, so many different thought processes. And I think it really depends on this new administration and how they handle things on what we could be seeing. But again, with what I'm reading so far, I would say I'm sticking with we'll be lucky to end the year at 6%.
Wow. I mean, they go on to say what could make mortgage rates stay the same or go higher. The biggest risk is inflation proving to be more stubborn than expected. If inflation doesn't get under control, the Fed will be forced to keep rates high to prevent inflation from spiking again. Supply chain problems and global tensions could also affect your mortgage costs. These disruptions could drive prices higher, fueling more inflation concerns. The strong job market presents another challenge. While good for the economy, robust employment numbers might convince the Fed to keep rates elevated longer. I never understand this. So the job markets is good and employment numbers are robust and the economy is good. So then you punish people?
Well, it's not you punish people, but there's no need then to drive rates lower because the economy's saying we don't need rates to be lower. Everybody's gainfully employed. Everybody's making money. Everybody's spending. So there's nothing driving the rate lower because there's no problem.
Well, it's not, I guess I understand what you're saying, but to me, it's not so much about there's no problem with people working. It's like the housing prices have gone up so much in the last 4 years that even though they may be working, their incomes aren't strong enough to sustain these higher home prices. So if the government really wants more people to be homeowners, then maybe they could help them out by reducing the rates rather than just looking at the inflation and the job reports. Like it seems to be one component that's missing, that during the pandemic, it was like, oh, there's a pandemic. Let's stimulate the economy. Let's give people money. Let's write checks. I mean, they were too happy to write checks and stimulate the economy and make money dirt cheap. Okay. Then the opposite happened during the pandemic boom, we call it, housing pandemic boom.
They want paid back.
Yeah. And now, right. Home prices are a lot higher.
Mm-hmm.
But
they did stimulate the economy, and exactly what they wanted to do happened. Now, unfortunately, we've got more credit card debt. We've got more home equity debt. It stimulated the economy, but we increased prices on the majority of our goods. Look at how expensive goods are now. So they're basically, this is the way that the government works to pay themselves back. Is that? Sorry.
Yeah. I don't want to pay them back. I feel like I pay them back every time I do my taxes. There's your money. Okay.
Don't shoot the messenger. I'm just letting you know how
it
balances out. And I'm not sure I have a crystal ball to know all of this, but this is what I'm going to hold my hat on, which is they want to keep seeing spending. And they are. People came out this holiday and spent. People are going and traveling again.
But you just said at the same time people are spending, but credit card debt is at an all-time high. So
because they're spending.
Sorry?
Because they're spending.
Understood.
They're shopping and they're spending, and then they're putting it on debt. That they're not paying cash, they're putting it on debt.
Right. So they're spending someone else's money. They're spending borrowed money. They're not spending their own money. So once again, I come back to my original conundrum, which it's not like I don't understand. I mean, I've been doing this a long time.
I do understand. That's why we came out with, whenever the interest rate environment is high, that's why we came out with those programs like the buy downs that really can help customers with the short term of mortgage rates. Or, also just maybe sometimes that I always like to do is tell people, put a little less down, keep a little bit of your own cash in a nest egg, because your mortgage payment is going to be slightly higher, but now you've got your nest egg to help you bridge the difference of what you wanted your mortgage payment to be and what it really is going to be. So if you wanted your mortgage at $2,500 a month, but when you talk to the lender, you found out it needs to be more like at $2,800, $2,900, potentially take that mortgage at the higher payment, but just put a smidge less down so you've got some extra money in the banks so you can grab $300 from maybe the $10,000 you didn't put down to offset that payment for a while. Because what do we know happens often? Income continues to grow year over year, just like values of homes at this time are growing year over year at about a 4% nationwide rate increase. And jobs are pretty much increasing at about a 1 to 2%. Depending on what sector you're in, and even more so.
So walk us down the buy down. Give us like a little example so people understand what that really means.
All right. So the only two factors you need to know up front is that you, the customer, can never pay for an interest rate buy down. it must be either paid by
Frankie, for some reason, I can't hear you as well. Just if you,
Can you
I
hear
don't
me
know.
now?
Yeah, I can now. Sorry.
I didn't.
Thanks.
Yeah, I didn't change the mic. So what you need to know about a buy down is you, the customer, cannot pay for a buy down. It has to be paid by the seller, or it can be paid by the lender. If it is paid by the lender, then the rate will be slightly higher than the going market rate. So if rates are, say, at 6.8 and you wanted the lender to cover the buy down cost, the rate might be at like 7.1. If the seller pays the buy down, it's with money, it's with cash. And how that works is, let's say, for example, there's a home you like and the price is $300,000. You might offer that seller $310,000, ask for $10,000 back to cover what is called a 2-year buy down. And they go 1 year, 2 year, 3 year, and then there's even some unique buy downs that are in between. But what it means is, at the first number you're hearing, that's how many years you will be in your buy down. We'll use the most popular buy down of all, the 2-1 buy down. So let's just use, for example, that rate at 6.875. In year 1, the rate would only be 4.875. And if you look at the delta between 4.875 and 6.875, that's a big amount of money you're going to save every month. And
Huge.
every month, huge. And it becomes how customers buy homes. And so what happens is, during that year 1, your rate is 4.875. Year 2, it's 5.875.
Okay.
In year 3, it goes to 6.875, which is in fact the true rate you purchased. It's kind of like a teaser rate, like, here's how we start you off. And it really helps, especially, again, if we know we have a customer whose income is going to change year over year, or perhaps maybe right now they're a 1-family household and they're going to be a 2-income household, and they know that they can take those jumps up. Or most importantly, while we are waiting for mortgage rates to drop, take this program and product and utilize it, because the beauty of the buy down is, 1, it gets you into that comfortable monthly payment you need to be in and makes you a homeowner sooner than later. 2, it helps you start gaining equity, especially with a 4 to 5% year over year appreciation rate. So no sense in sitting on the sidelines not buying, because so far, and I bet you agree to this one, haven't really met the person that when waiting to buy has ever benefited. Never in all my years have I seen that. And 3 is, at any time you can refinance out of the buy down, and any money that the seller paid into the buy down that was not used by you, the customer, is given back to you. That is awesome. So if you're in, yep. So let's say you're in, yeah.
So how much does it cost for the buy down? And what do you mean? It's not like a one-time thing and this buys you 2 years?
That's right. It's not. It's all based off of interest rate and loan amount. And every person's is going to cost different, because we don't know how much the loan amount would be or how much the interest rate is. I could read to you, if you'd like, an example of one. Would you like an example to see the delta, or is that taking too much time?
Okay, no, I mean, I think it's interesting to see.
On the outside chance you wanted me to read you one. So
thank you. And then while you're bringing that up, I'm assuming that they have to be qualified for that final interest rate for the 30-year loan. Like, it turns into that for the rest of the 28 years, correct?
Correct. 100% correct.
Okay, so they have to qualify for the higher rate, and that's what, it's never going to go higher than that for the 30 years with this particular loan program. But the first 2 years are different.
Right. So, for example, let's say you had a customer buying at $1,250,000. And let's say
we're fancy over here, people. We're going 1 million, 1.2 million.
This is what I'd done the sample on. And let's say they put down 25%, because it really doesn't matter what the price of the home is. It matters what the loan amount is. That's how you base the cost of the buy down.
Okay.
That means that they're buying the property at, or the loan at $937,500 at an interest rate of 7.125. The principal and interest is $63.16 a month, just principal and interest without taxes and insurance. But with a 2-1 buy down, that rate goes down to 5.125%, making the principal and interest $5,105, a savings of $1,211 every month for all of
month.
A month.
That's
so
huge.
again, right? So again, they have to be able to qualify at the higher payment. And that buy down cost the seller $21,000 in that specific scenario. But why that made sense is because let's just say it was a property that was looking to reduce its price because maybe it wasn't moving or selling on the market. Instead of taking a price cut of $21,000 off the price, they just offered a $21,000 buy down. And now they got buyers excited about buying their home because the buyer now has a mortgage payment that's palatable. It's something they can stomach. It's something they can handle. They know that eventually it could go to 7.125. But again, if we're listening to that earlier article, if rates go down to 6% by the end of year one, they could take it and just go into 6% then and refinance. So any money that was left over in the buy down bank of that $21,000, let's say at year one, $10,000 is left in the buy down bank. It all goes back to the customer.
Wow.
Payoff. They never lose the money. They never lose the money. It's a win-win.
So is the buy down generally 20% of the purchase price, or is it?
No, it's based off of the loan amount and the interest rate.
Okay,
It's just whatever the customer decides to put down.
Gotcha.
So in this case, I was just trying to get to a loan amount. So on that price, I assumed somebody buying at 1.25 million would be putting down close to 25%.
Yeah.
You know, because usually folks in that price range want to put a lot down and then borrow a little bit less. But everybody has their number. And I will tell you that buy downs made up at least like about 9% of mortgages. And they were a very popular vehicle in the last few years. And they've really helped customers because here's the best part. During that time, property values have appreciated. The customer now has a tax write-off, and now they become a homeowner, and they're not paying someone else's rent with no tax breaks.
So while we're on the subject of different ways to get into this market, besides putting 20% down on a conventional loan, we got the buy down. That's one way if the seller will cooperate. Even if you inflate the price, the seller has to cooperate because you could run into appraisal issues. So it all has to be negotiated.
Yes.
Other ways are, and we spoke about this in today's meeting, are the government loans, FHA and the VA loans. People get scared of these loans. And honestly, I'm not really sure why. Can you just tell us, like, what do you think? Do you think they're good alternative programs to conventional? Do you like them? Do you see any real problems with them? Like, where do you stand on FHA and VA loans?
Well, if you are a veteran, first of all, listening today, thank you for everything, for your service and everything you've done for us. And secondly, you deserve to be rewarded. And by all means, the VA loan is by far the very best mortgage out there, in my opinion, because you can put no money down. You do have no mortgage insurance ever on a VA loan. And it allows you the ability to get up to 4% of the sale price towards your closing costs. So if you're a veteran who unfortunately might not be making top dollar, you can actually become a homeowner quite instantly with little as a couple $100 down and stop renting and get a great rate. And in certain states, if you're a veteran that might have disability with the VA, you do not need to pay what's called the funding fee. And that funding fee you never even have to pay in dollars. It's something that gets rolled right into the loan. So again, you can really come to settlement with no money, meaning you can buy a home as a veteran with no money down.
Yeah, I've had that. I've had VA clients that have bought with no money down. And I've also had disabled veteran clients who actually, they get a break with property taxes as well, and a whole other slew of things.
That's what I was going to add. Yeah, I was going to add in certain areas, most. And again, nobody wants a veteran to be disabled, but if they are to a certain percentage, that state will waive property tax. So in many cases, a veteran can buy a home and actually pay less than their rent and go right from rent to ownership without really having to worry about a big savings down payment. And it's a great loan program. And the rates on those are historically lower than standard mortgage rates. Again, the GI Bill and the veterans loan, my dad was in World War II. Our interest rate on our home was 1.9% in 19, I think it was like 50 something. Clearly they never refinanced that loan. So I will say that it is one small way we can thank our veterans. So I very much like that loan, and I think it's a great program.
Yeah, let's just go back to a little chart here. So for the 30-year fix for conventional, they have 6.87%, 30-year VA, 6.36%, and the 30-year FHA, 6.33%. So both government loans are pretty similar, but not significantly, but lower than your conventional loan. You have
yes, and also remember with the conventional loan, if you were to put a down payment of under 20%, you would have to pay mortgage insurance on top of that. Now, on the FHA loan, so my number one favorite you asked is the VA loan for customers. I know that there's reasons why sometimes they might be hard to ratify a contract on a multiple bidding war, but they are still a great loan program. The other loan program that is also really great for first-time homebuyers is the FHA loan, because again, it has a slightly lower rate. It is much more forgiving on your debt ratio. It is much more forgiving on your credit scores, and you only need a 3.5% down payment. On this loan program, the seller can pay up to 6% of your closing costs. By the way, every one of those programs we've been discussing, all of them allow buy downs. They can all start off with a significantly lower rate to help the customer get into the home and have a very comfortable payment, maybe similar to their rent, until they get used to mortgages, until their income increases, and until they have the opportunity to refinance. So the FHA loan has this huge plus over the fact that it's forgiving on credit score and debt ratio, and you only need a 3.5% down payment. There is a downside to FHA loans, and that is you carry what's called the monthly mortgage insurance for the life of the loan. It doesn't go away until you refinance. But again, often, if you're not putting down 20% anyway, that FHA mortgage could cost you less in today's current environment than a 30-year fixed rate if your credit score is not perfect. So all these different loans are all meant to satisfy the needs of all customers.
Yeah.
There is not one size fits all.
So in my experience as a real estate agent for 22 years, yes, I'm that old. I don't really get a lot of pushback with VA loans because I'm very adamant, like, you mess with these VAs, you're messing with me. And I get very angry about it. And I think I might give off that vibe because it really does offend me, just to be honest. And when they start getting scared about repairs and this, and they need a railing, if we've seen the house, I've looked at the house, I've listed the house, I kind of know what, or even if I represent the buyers, I've looked at the house, I kind of know what possible repairs may come up after doing this so long. It's all about safety. We can talk about that and what that will cost. And there's ways to deal with that. FHA loans, on the other hand, I definitely get a little more pushback on than VA, because VA, I don't think that they'll mess with that. I'm not sure why FHA has such a bad rap. I don't know if the appraisers are stricter, than conventional.
They used to be. They used to be, but they're not anymore. It's really not much of a difference. Every appraiser is always going to look for safety of the consumer and make sure that the house is safe. FHA, I would say the two items that are a little bit more strict than a conventional loan is peeling paint and handrails. Peeling paint and handrails. Yeah. But other than that, you're not going to come up with too many other red flag items at all on an appraisal of an FHA loan. And I think the biggest thing here, Caryn, and I know you always recommend your buyers to do this, is get fully vetted up front. Make sure you've sent in all of your documents to your lender and had them pre-approve the loan. That's great. But getting the loan underwritten in advance, especially if you aren't planning to put down a large down payment or can't close within 10 to 15 days if it's a competitive offer, getting your loan fully underwritten in advance is going to be that game changer that makes everything different.
Yeah, for sure. All right, I want to jump to, I've got another article and I have some other notes that I want to talk to you about. Before I go to the article, I want to talk to you about something that you sent us. And that is the difference between what is good debt versus bad debt. And you sent this to everyone in the office, and I thought it was really interesting because a lot of people hear debt and they just think everything is bad. I have debt. I can't buy a house because I have all these student loans, or I have, I can't buy a house because I have, I'll never, mostly student loans. My experience, people are like, there's no way I can because I had to take loans out to go to school. So when you send this out, like I could read it off. It's pretty long. Since you sent it, I figure, or I can read it, whatever you prefer.
Mm-hmm.
What is the difference between good debt and bad debt?
I think for every customer, it's a little different. Okay. But good debt is debt that you can pay, first of all, right? So obviously, the lower the interest rate on a debt, the better the debt. A debt that's going to improve the rest of your lifestyle and free up cash and balance you is good debt. Student loan debt is good debt if it helped you advance your degree. It really does matter per household. And I would say that where it says here a car loan is bad debt,
right?
It's just because of the fact that cars depreciate so quickly. I don't know if you've ever bought a used car or ever heard the story. Once you drive off the lot, it just depreciated when you buy a brand new car. And I don't know if you're like me growing up, that my father never let me buy a brand new car ever. And now I want them, but I still try not to buy them because of that component. But I always say that while these articles are great that kind of go over good debt and bad debt, I think it's the best way to do it is to figure out what you can pay back monthly and to make sure that all of it is getting to your end goal. And so always mortgage debt is my favorite debt to have, not just because I sell mortgages, but because it has tax benefits, because it's gaining you equity and it's helping be an additional asset in your diversified portfolio. So just like some folks go, oh my God, I buy all the cryptocurrency I can get my hands on. Or someone else might say, I'm so heavy into stock trading, I'm almost a day trader. Or someone that just says, every month I put in extra money and I max out my retirement. All those things are great. But if we don't have a balanced portfolio and have that happening at the same time we're trying to own real estate, we've not really diversified ourselves into a position where we know what was our good debt and our bad debt. And a lot of that is based off of our savings patterns as well. So
as far as qualifying for a loan, is all debt equal? Like, it doesn't matter if it's your credit card debt, your student debt, it doesn't matter what it is. When you're qualifying for a loan and they're looking at your income to debt to income ratio, do they care where the debt's coming from?
They do. So I'm going to give 3 really amazing tips to what I would say is bad debt if you don't have it under control. Okay. First of all, if you have a credit card and let's say its available credit is $10,000 and you constantly stay maxed out at $10,000, from the credit bureau standpoint, you look like someone that's having a tough time getting out from under. You can't manage your monthly debt. You constantly are just paying finance charges. You're never getting out from under, and you look like you're maxed out because you are maxed out. And so your credit score will take a hit to the negative if you run up your credit card over 50% of the max allowance. So I have a lot of customers that say, oh, but this one's all at 0 interest. And I love that. I love 0 interest, but not right at the time you're buying a house, because maybe you've put all of it on that 0 interest credit card. And that's now looking at 20,000, but all your other credit cards are at 0. Your score may still get dinged a little. So I always try to tell folks to run your credit cards at 50% or under utilization when you're trying to buy a house. Two other huge takeaways. Leases on car, as far as a car debt goes, can never, ever be excluded in your mortgage calculation of debt ratio. If there's a lease, we are always going to assume that even if you only have 4 payments left on it, that you're going to get another lease. That's just the guidelines of how Fannie Mae and Freddie Mac and lenders consider debt. But if it's a car loan and you either have less than 10 payments left, or you can take your car loan and make a payment on it to where you have less than 10 payments left, the majority of loan programs will say any type of installment loan, I used car loans in this example, we will exclude them from the debt ratio because you have less than 10 payments left and it's a loan, not a lease, and that can help you qualify for more home loan. So there are many times when I'm talking to customers and I may see that their payment is $500 a month and they owe $6,000 on their car. And I'll say, hey, can you pay one more $1,000 down on that car right now? And then I don't have to count that $500 payment in the car in the debt ratio. And now I can get you a better interest rate. So those kind of tricks of the trade, which go into better debt and good debt, and why you always want to have someone in your back corner helping you with that. And that goes, by the way, for all types of installment debt, student loan debt, any debt that's paid on a regular. Let's say you buy an engagement ring and the payment is set. That's installment debt. And revolving debt is all other debt, such as credit cards or a loan that you take out where the payment fluctuates. So always my favorite debt is installment debt over revolving debt. I know that was a lot.
Okay. Installment debt over revolving debt. And so I didn't know about a lease. And my daughter, who's going to be 21 next month, just got her first credit card that's not connected to mine. Yay. And she's like, I was trying to teach her. And I'm like, she's in Spain this semester. And I'm like, okay, they are lending you or they're allowing you a $3,000 credit limit on this credit card. She's a student. I was actually surprised they gave her that much, but they did. I said, try not to go more than half of it. Try to keep it the balance under $1,500. And then she got confused. She's like, she called me from Spain. She's like, oh my God, I'm almost $1,500. What am I doing? I'm like, well, you can borrow up to $3,000. I'm just saying for your credit score, for a good habit, try to keep it at 50% or less, but you have access to up to $3,000. If you're traveling right now and you're going to pay it back next month, you can do that. They're allowing you to do it. But just a good rule of thumb to start good habits now is to try to think of it as half as much.
Mm-hmm. I love that idea. Way to go, Mom. That was a good one, Caryn.
And then what was your third? You said you had 3 things. The first one was...
Well, I think I think I added in together kind of the revolving debt against installment debt tied in with the less than 10 payments. So that was the third. That was the third.
That's good. I didn't know about leases.
It's a big one because a lot of people are like, well, but I only have a couple payments left. And that's just not how the lenders will treat it. And so I always tell folks, it's really important that you make sure if you're thinking you're doing other big purchases during the time you're buying a home, you really get your ducks in a row well in advance. I can't begin to tell you how happy I am when I actually talk to a buyer that might not be buying for 3 to 6 months, because then we have the opportunity to make some adjustments and make some shifts to help them get the best interest rate possible.
And what about debt consolidation? Because, it's so funny. Before we even started this live stream, I was watching TV or something, trying to relax, and the commercials come on. Consolidate your debt. We're here to help you. Debt consolidation. And it's like, I hear these commercials and I see them and I think scam, scam, scam. Like, is it like, what is debt consolidation a good thing, a bad thing? Does it help you when you're trying to buy a house? Like, what are your thoughts on that?
Usually I'm against them because most of them are unfortunately costing the customer more money, and they most of the time are a scam. So I always say buyer beware in that case. And if you're going right to your local bank and saying, hey, I want to get a debt consolidation loan, and your banker, that's different. But if you're looking online or you're just going to somebody who you're seeing call 1-800 number, that's someone who's actually going to add more fees to the debt, but they're going to make it look like they've lowered your payment. And then they're going to stretch the debt out longer. And sometimes if you, like in any industry, I'm sorry to say, there are some people that may even tell you, hey, but in order to get into this program, you've got to miss some payments. Anybody who ever tells you to miss a payment on any debt, ever, do not walk, run. It's not accurate. You do not have to miss debt to get help. So you need to look at really finding out maybe a family financial advisor to connect you to somebody good in the mortgage industry or debt consolidation. I know that sometimes we can get ourselves in over our head, but also calling directly to those creditors and saying to them, hey, I really am struggling on my monthly payments here. I want to pay you back. I don't want to be late. I just need a reasonable monthly payment so I can get ahead of things for a few months. And you'd be surprised how many of them, especially since COVID, are more willing to work with us than ever, because there's still some people that are still coming out of that COVID pain without being without work for a long time and falling behind on some things. It was a very scary time in our country. And we always tend to forget and then do the same thing over again. So I'm not a huge fan of the 1-800 debt consolidation. But if you know the person and it's a small bank or a bank that you trust, and they're saying, hey, I can wrap this and this and lower the interest rate, and you're not paying any added fees, then maybe it's a good option.
So along those lines, what are some other things to look out for? If somebody says miss a payment and you'll qualify, that's one of them. What else are you seeing? I mean, I know we've had a lot of wire transfer frauds where in my business where hackers are hacking into title companies' emails, real estate agents' emails, lenders' emails, and saying at the last minute, wire your money. The wire instructions have changed. Wire your money here. They do. The money's gone. Besides those scams that I've gone over on a couple of my videos, have you seen anything else? Any other warning signs? You see a lot of
upfront money. If they want a lot of money up front, like I'll help you get out of debt, but you've got to give me $1,000 to get there. I would be wary of that. There shouldn't be a fee to help you get out of debt.
What about when buying a house? Like when you see a lot of the internet lenders online, with these, here's our rate, it's 3%, it's COVID rates, all this stuff. Like sometimes people call me when they want to buy a house and they said, oh yeah, I'll speak to your people, but I already saw this and I already went online and I know I can qualify for this. But I'm like, you're not reading the small fine print. You're not looking at all the fees. You're not looking at apples to apples. Like what are some things that you've seen that people should be aware of?
Well, I'll go back to another saying, like there's no such thing as that free lunch, and buyer beware. So if we're going through and we're telling you the national average of mortgage rates is at about 6.7, let's just say, and somebody says, I'm going to give you a brand new loan and it's going to have no bells and whistles. It's not a temporary buy down. It's just my 30-year loan is at 4%. No, it's not. No, it's not, because the national average wouldn't be that. And then this bank offers something so astronomically different. So you really, it will always go back to that favorite word of trust. And if you don't know someone and you haven't read reviews and you are searching for something online, you need to back it up with making sure that you know the person, that you can trust the person. And if you can't answer that you trust them and that you haven't read every document they've sent your way, I would say go the other direction.
Yeah, I know.
I don't want anybody getting stuck. That's all.
I had a transaction around Thanksgiving that scared me. I've been doing this 22 years, and this thing, I've never been more stressed out because the deal was supposed to close Wednesday, the day before Thanksgiving. And it was a private sale. And I represented sellers. I was a listing agent. And an investor came to me, like a lot of them do, paying cash, wanting to buy this house. And everything checked out, and the title company checked out their title company. Long story short, Wednesday came and went, and the money wasn't there. And I was, what are they doing? What is the scam? What is happening? And then Thanksgiving was Thursday, and then the title company was closed on Friday, and the Saturday and Sunday. Come Monday, I'm back like what's going on? And everything in me was screaming, there is something wrong here. Monday morning comes, money's still not there. Monday noon, and now I'm calling our title company. I'm calling everybody I know. I'm like, somebody tell me what's happening. 'Cause I was getting ghosted. Long story short, it did close Monday afternoon, right? Did a video about it and about some other scams that were happening, like the wire fraud. And one of my viewers, I got a lot of comments on the video. One of my viewers said, here's what they were doing. I don't remember exactly what he said, but it was something about, he goes, look and see if that house is going to be on the market. It was on the market in the next couple of weeks and sold. And so I looked on our MLS, I'm like, no, it's not on the market. Turns out I did a little deeper digging, and on Redfin, it shows up having sold 12 days later for $45,000 more. And what the viewer said, I don't know if this is true, but the viewer said is that's the way to avoid paying taxes on it. And so what my mind is thinking, and if you're watching this and you are the person that did this, I'm not saying you did do it. I'm just saying you might have. What I'm thinking is a possibility is that this was tax fraud. And if they didn't find a secure buyer that was going to close in those 12 days, they wouldn't have closed and we would have had to start over. Now, like I said, this is all hypothetical because it all closed just 5 days late and it was fine. But there's so much going on out there that is just not above board. I will never work with an investor that I've met face to face again. I never met them. It was an LLC. It's awful. Did close. It was fine. But there was something going on behind the scenes because you don't close a house 12 days later for $45,000 more. And it was never public, you know?
There's different scams in the mortgage industry. One is called churning.
What's that?
Draw buyers. Churning is when the property continually flips like you're describing right now. There's a lot of times, I don't know if this ever happened to you on Airbnb site, but it also happens in the real estate world where you'll see a property listed and it looks great and it looks like this agent is hosting the listing and you come and you drive by the property. It's not even for sale.
I've heard of that.
That happened to me down in Rehoboth. I was looking to buy a piece of land and I saw this price and I was like, this piece of land is only that much. Oh, I could build my dream house. And then I reached out and it turned out that the people who own that land have no intention of selling that land. It's family land. And somebody just put it up on the internet, said it was for sale. And I could have gone into contract, but thank God I did some sleuthing and I had my realtor and she's like, Franckie, that is not a real listing. That is not a piece of land for sale. And it looked completely legit after 26 years doing this. It looked like a normal sale. I know many people have seen that happen in Airbnbs where they'll get fake pictures and so forth. And then you show up at the home and either the home's not even there or a million things. So you've just got to really be careful. And I hate that, right? I hate that. And I know you do too, that we have to warn people and make sure that they know that there are a lot of things out there that could be happening. But it really always boils down to trust, Caryn. And I know your listeners trust you 100%. So
this is why I say to people, especially first-time buyers, if you bought before you've experienced at least, and probably a little bit more than somebody who's never bought. So when first-time buyers come to me, I'm just so happy because I'm like, I know you're going to be protected because I will protect you. I will vet things. I will hook you up with people like you, Franckie, that I trust that are going to help you out, that will give you that advice. Like, hey, you only have 11 car payments, left. Pay this, we'll do this, we'll tweak this, I try to get people to you as soon as possible. So if there are any issues and you're so great that you will do a soft pull for people, explain the difference between a soft pull and a hard pull.
So a soft pull is just what it sounds like. We're not doing anything that's going to be detrimental to your credit rating. It is really nothing more than an internal view of seeing where your credit scores land. That way we can give sound advice on things that we might want to have you do in advance before we ever do a hard credit pull. We can actually run an automated approval through that system. We can see that the loan will be completely approvable. We can issue pre-approval letters with a soft credit pull. We cannot go to closing without the hard credit pull. That is when we then will let you know that we're going to, with your permission only, pull, and also the soft pull would never happen without your approval, okay as well. And then once the hard pull has happened, we do two other steps. The most important one is the opt-out button, because believe it or not, pulling credit is also something that can be easily triggered by what I call the ambulance chasers. And then the next thing you know, you're getting phone calls all day long saying, I see you're looking to buy a house. I see you want to get a mortgage. Talk to me, talk to me, talk to me. So we have a way that once you do the hard credit pull that you can opt out so no telemarketers can get your information. And not because Origin Point is selling your information, it's a matter of record. So these ambulance chasers literally are sitting by on the phones waiting for that information to come through and start bombarding you. And 90% of the time, they're going to tell you you can have a deal that's not achievable, that is a false data from start to finish. So that is the difference between a soft pull and a hard pull. And I encourage folks to do it. Like I just had one yesterday where she did a soft credit pull. And I said, I even have a simulator that can tell me if you do these activities, your score has the potential to go up by 30, 40 points. And since you're not looking to buy for 6 months, do those things. And I will not do a hard pull until you've said you've done those. And then when we do the hard pull, hopefully we'll see that achievable higher credit score to get you a better rate.
So just for people out there, if you've never bought a house, in order to get approval for a home loan, they have to pull your credit score. And between your credit score and other criteria like your debt to income ratio, your income, all the other stuff, your credit score is also a big part of that equation that tells them how much the bank will lend you and how much you're approved for. A hard pull is when they go to the credit, three different credit unions,
bureaus,
and they get the hard credit score, but it also dings your credit when they do that. A soft pull is that she can still see your credit score, but it's not going to ding your credit, because if you get too many dings, you apply for a credit card, then you apply for a car loan, then you apply for a house loan, and it's ding, ding, ding. Your credit score will suffer as a result. So you don't want to have all of these hard pulls at one time for different things. If they're like-minded, I think it count as one, right? You can get a hard pull from different lenders for a house mortgage. And
within a 2-week period is normally what we say. You could do, I would say, successfully like 3 hard credit pulls with 3 different lenders, all within a 2-week period. But try not to go above that amount, because also, again, the credit bureaus are thinking, why is this consumer going from this bank to this bank? Are they trying to buy multiple homes at the same time with different lenders? Should we be flagging and dinging their credit score because potentially they're going to be taking out multiple loans, which, by the way, before the mortgage crisis of 2008, you would be blown away at how many people simultaneously wrote contracts and bought 3 and 4 homes all within a week's period. And so again, these are all the safety nets that had to be put in play after 2008. And so, and I've seen that as well. It blows my mind what some people have done. So I always just say, vet people, get to know them, get referrals, make sure that this is someone that you really know you can trust. It's one of the biggest financial decisions of your lifetime.
Yeah, but if you did want to compare rates, my understanding is you could speak to different lenders.
You could, but you could do that off a soft pull too. I would say
not everyone does that, Franckie. You do a soft pull, but not every lender does, in order to really give them proper information. And that's why I love referring people to you. And I tell them when I talk to them the difference, because like you said, some people may not even realize. I had, I forget, one of the people in our office, one of the agents in our office, who had a client, or maybe you told me this, where they didn't pay a parking ticket. I think you actually told that story in the sales meeting one time, and they forgot about it, a parking ticket, and then that caused their credit score to go down. Like, some people don't know, and they just forgot, And
medical collections is huge. So like right now, for any listeners that are out there, if you've been getting this constant message or letter in the mail that says you still owe a $35 copay, pick up the phone. Make sure you don't owe that $35 copay. Nothing will be worse than 6 months from now, you're ready to buy a house and they say, well, we mailed you 30 times and told you owed us $35, but you never paid it. So we sent you to collection. And then you've got a collection on your credit report and you're like, this $35 can't hold me up to getting a better interest rate. And you're like, that caused your credit. A collection can make your credit score go down 20 to 30 points.
Wow. Yeah. For $35. So there's a lot. We already ran out of time. I still have a whole list of stuff to talk to you about. Hopefully you'll come back on again.
Always.
Here's the bottom line, people. First of all, if you have any questions watching on the replay for Franckie or myself, put them in the comments. I will make sure I get them answered if they're for her. And if you want to speak to a reputable lender who will talk to you about your situation and the different programs, whether it's VA, FHA, conventional, buy downs to ask for this, that. Obviously with buy downs, it's got to match the strategy of getting that house, depending what market you're in. But it's all good information to have, and it's all free. No commitment, all free, so it's worth talking to a reputable lender like Franckie, who I trust. Been doing this 22 years. A lot of people trust because she's good at what she does and really cares about people. And I think that that's a big component of our industry, that it may all be transactional, but within the day, it's about people and their homes and their families and their memories. And, you got to have somebody that you trust.
Thank you. I love what I do.
Thank you,
Caryn.
All right, everybody. You all take care. Have a great night. Join us again next Wednesday night. Please join us live, 6 o'clock. It's a lot of fun. You can ask us questions. And I hope to see you then. Take care, everybody. Have a great night. Thanks.